Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe, and additionally, I'm the branch manager here at Serving Those Who Serve, Sipe Ed Associates. I want to begin, as I always do, by saying thank you. Thank you all for your service. And I think people are stealing from me because I saw a GEHA commercial. I couldn't believe it. And it was showing all the amazing things federal employees do. And then they thanked you. And I said, that's my idea. But now there's at least two groups that are saying thank you. So there was just me, and now GEHA's picking it up. And it is my hope that everybody catches on and remembers to do it. You don't hear it enough, you'll always hear it here. The other thing that you're always going to hear here is Ed Zurndorfer. That's right. Guru's back with us again, part of that ongoing mission. You know what it is. Our mission is to reach, teach, and serve you. Before we jump into that, at the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve, and that this podcast is presented for information only and is not intended to be taken as advice. All listeners, that means you, should consult your personal tax advisors in general, before taking any action. You don't have an advisor, hit us up at Serving Those Who Serve. We'll help you any way we can. If you listen to the last podcast in this series, we are continuing our conversation about the Secure Act, which is continuing to evolve. We had Secure 1.0, now we got Secure 2.0, and how it impacts feds when they inherit IRAs, TSPs, 401ks. So, Ed, if someone's joining us midstream, let's say they didn't, I can't believe it, but let's say they didn't listen to the previous podcast. You did a really nice job of introducing the Secure Act in our last episode and kind of what it did. Can I ask you to do that again in case somebody's jumping in midstream?
Absolutely, Dan. The Secure Act was passed in December 2019. It took effect on January 1st, 2020. And among the major features of the Secure Act was the fact that anyone who died after December 31st, 2019, who owned a traditional IRA or was a owner of a workplace retirement plan such as a 401k, 403b plan, or the TSP, their savings plan, and they passed away, named a beneficiary. That beneficiary, if that beneficiary was not what is called an eligible designated beneficiary, and I'll list those again, who are considered to be so-called EDBs. If that person was not an eligible designated beneficiary, then that individual had to withdraw the entire amount of their inherited IRA, traditional IRA, or workplace workplace retirement plan within 10 years of the death of the IRA owner or workplace plan participant. Before the passage of the Secure Act, anyone who inherited, let's say, a traditional IRA had the option. They had to withdraw all the money in the account. They just couldn't leave it there indefinitely, but they could take the money out over their life expectancy. So the example I was using is that, let's say we have an 18-year-old who inherits an IRA from grandma or grandpa worth, let's say, about $200,000 at the time of grandma or grandpa's death. That 18-year-old who has a life expectancy, let's say, of about 75 to 80 years, could take the money out over that 75 to 80 year period, taking out a certain minimum each year called the required minimum in that year, based on the account balance and their age at the time, and stretch it out. This was a so-called stretch IRA we hear so much about. The person would get a lifetime income. if they take out the minimum, and it grows sufficiently, and the IRA grows sufficiently over time. Under the Secure Act, that is no longer, that was no, under the Secure Act 2.0, the IRS came up with the new regulations. It has not been passed by Congress yet. It's still in the House. Has to be the House Representatives did pass it, but it's in the Senate now being worked on. And once it is finalized, the Senate, I guess, will get together with the House and come up with a compromise, and it'll go to President Biden's for signature. But here's the point. The most important thing that individuals have to be aware of, that is someone who is not an eligible designated beneficiary, such as a child, that child, or I was using the example of a grandchild, has to withdraw all of their inherited IRA assets or inherited workplace retirement plan assets within 10 years of the death of the IRA or of the original owner. They cannot stretch it out. That was probably the most important feature coming out of the Secure Act 2.0. IRS also
big change.
Did something that surprised a lot of people. I'm one of them. Said that not only do they have to take out a non-eligible designated beneficiary, has to take out all the money within 10 years of the death of the original owner. During years 1 through 9, they have to take out what's called required minimum distributions, RMDs, each year. So that was a shocker. That was a shocker,
sure.
And it will be passed. It will be passed into law, and this year. And this is going to be the first year that anybody who is not an EDB has to take out an RMD for the year 2022.
Gotcha. Well, that's to the point as always. So let's press on, Ed, into the new article, and we're talking about how the Secure Act will impact Feds who inherit a Roth IRA. So,
very interesting.
Little
the Roth IRA, different animal entirely, Dan. As many people know, that the Roth IRA is the only type of retirement account that is not subject to required minimum distributions with all the other types of retirement accounts, and that would include a traditional IRA, any type of qualified retirement plan, and the TSP. Traditional 401k, traditional 403b, traditional TSP, they are subject to RMDs. By the way,
Gotcha.
Dan, someone asked me, what about the Roth TSP? The Roth TSP, is it subject to RMD? Actually,
Excellent
indirectly
question.
it is. It is. Because when the TSP calculates an RMD for somebody who's past their required beginning date, which is for most people now is age 72, they combine the traditional TSP account balance and the Roth TSP account balance to calculate the RMD.
Gotcha.
If I can just take a side here, I advise those federal employees, federal retirees who have not reached their required beginning date yet, before they reach their required beginning date, which again is for most people now 72, to please transfer their Roth TSP account to a Roth IRA. You can do that tax-free, and this way the Roth TSP will not be subject to any type of, indirectly be subject to any type of RMD. And I cover that during my TSP webinars, by the way.
Gotcha. Now, real quick, so I stay on the right side of our compliance department. As far as the SEC rules go for a broadcast like this, whenever we come up with the thought that somebody might roll something out of a place like a TSP, we are ethically bound to also say you can leave it in TSP, you can pull all the money out. There are always multiple options that you can follow, and Ed is not giving advice to individuals here when he's talking about some of the conversations he's had with people in the past. So at any point in time, you need to understand, folks, if you're listening to this, that you can always leave things where they are. You can always consider moving them somewhere else. You can always consider moving them to a plan with a new employer. You can always consider just taking all the money out. So legally, we always have to say that to make sure that we're staying on the right side of compliance. Sorry about that, Ed. That's something I learned this last couple of weeks with the way they're interpreting these rules. Just want to make sure we put that in there.
No problem, Dan. It sounds good. Sounds good to me.
So,
Getting back to the Roth here, the Roth
Yep.
IRA is not subject to RMD, and someone who has a Roth IRA, when they reach the required beginning date, which again, technically speaking, the required beginning date is April 1st following the year that you turn age 72. So that is if you were born after June 30th, 1949. If you were born before July 1st, 1949, your required beginning date is April 1st following the year that you turn 70 and a half. That was
Gotcha.
also a feature that came out of the Secure Act, by the way, the Secure Act.
Mm-hmm.
But I just want to mention that once again, the Roth IRA, no such RMD rules apply to that. And therefore, the Roth IRA, if someone inherits a Roth IRA from someone who died after December 31st, 2019, because the Roth IRA is not subject to RMD, that non-eligible designated beneficiary, a non-eligible designated beneficiary, while they are subject to the 10-year rule meaning they have to withdraw all of the money from their inherited Roth IRA within 10 years of the Roth IRA owner's death, the original Roth IRA's death, but they'll pay no tax, but they do not repeat.
Gotcha.
They do the non-eligible designated beneficiary is not subject to any RMD during years 1 through 9 following the death of the Roth IRA owner. That's a big difference now as opposed to the traditional
That's a
IRA.
very big difference.
And in my opinion, Dan, this is strictly my opinion once again, the result of all this is that Roth IRAs are going to be more popular now. Roth IRAs have always been popular. One of the reasons is you don't have to pay tax. If you make a qualified distribution from a Roth IRA, you don't have to pay any tax, including on the earnings. So those TSP account owners who are contributing both to the traditional TSP and the Roth TSP, and you can do both, be advised that if you're designating, let's say, non-eligible designated beneficiaries such as children, such as grandchildren, and you can, that in terms of the Roth TSP, you're encouraged that after you retire, please transfer the Roth TSP to a Roth IRA tax-free. That's my recommendation. Because while your non-eligible designated beneficiary does have to take out the money from the Roth, their inherited Roth IRA, within 10 years, at least they won't have to pay any tax. And you're not going to be subject to RMD.
So Ed, this actually kind of brings me to questions. I'm thinking this through. So let's say I'm a Fed, and I've got traditional TSP and I've got Roth TSP, and I pass away, and somebody is my beneficiary other than my spouse, and other than a disabled child or something like that. When that is coming through to that person, is this going to break into two different chunks of money, one traditional and one Roth, when they inherit it?
Yes.
Okay.
Yes. If you,
Okay.
because the
That makes
same
sense.
person, you name one beneficiary for your TSP account. For those individuals who have not, and federal employees who have not filled out the TSP beneficiary form, TSP-3, please do so. I encourage you, and that also applies to uniform services members who have TSP accounts. They should fill out their TSP beneficiary form. But you cannot name one beneficiary for your traditional TSP account and another beneficiary for your Roth TSP account.
Understood.
It's going to be the same beneficiary.
Yep. Okay. Now, it's always the case, Ed, your articles frequently introduce us to new terms that we might not have thought about. And this is no exception because you bring in the term successor beneficiary. So this is a person that inherits the inherited IRA or Roth. Is that correct?
That is correct. The formal definition, a successor beneficiary is an individual who inherits an IRA from the original beneficiary of the IRA. Okay. Under the Secure Act, Dan, this is Secure Act 2.0, the rule is that a successor beneficiary is also subject to the 10-year payment rule. Okay. But the application of the 10-year payout rule will depend on two factors, namely, one, whether the original traditional IRA owner or retirement plan participant died before or after his required beginning date. I mentioned what the required beginning date is, April 1st, following year you turn 72, if you're born after June 30th, 1949, or April 1st, following year you turn 70 and a half if you were born before July 1st, 1949. And the second rule, the second factor is whether the original beneficiary is an EDB or a non-EDB. And in my article, I went through 3 scenarios with examples to make it clear what has to happen. What has to happen. And it's all in that let me just give you one example. Suppose the original traditional IRA owner or retirement plan participant died before his or her required beginning date, and then the original beneficiary is a non-EDB, is subject to the 10-year payout rule. In this scenario, the successor beneficiary is subject to the same 10-year payment rule as the original beneficiary. In other words, the 10 years is the deadline for taking out the end of the 10th year following the death of the original IRA owner or retirement plan participant. But keep in mind, and I don't think we mentioned this in our first podcast, but it's really important that we mention it now, that if the original traditional IRA owner or the retirement plan participant died before his or her required beginning date, then no RMDs are required in years 1 through 9 of the 10-year payout period. The RMDs are only going to be required in the case for non-NDBs if the original traditional IRA owner or retirement plan participant died after his required beginning date. Very important distinction, Dan.
Okay. Sure. Although if they keep pushing the age further and further and further out, that may become a little more or less common depending on that. But wow, that's a head spinner, Ed. Okay, so let's take a deep breath, reset, and regain our balance, and talk about how Secure is hitting situations where folks may have made a trust their IRA, TSP, 401k beneficiary. That's not a get out of jail free card, is it?
Yes, Dan. I get this question quite often from clients, and we do our TSP webinars. We get this question quite often. Can I name my living trust as beneficiary of my TSP, or I have an IRA? Can I name my trust, my living trust, as the beneficiary of my IRA? And the answer is yes, but you got to be very careful here, okay? There's certain rules. Only certain types of trusts can qualify as a designated beneficiary of an IRA or a workplace retirement plan, such as the TSP. And this is strictly for RMD purposes. If I may, I'd like to go through the requirements that must be met in order for a trust to be treated as a designated beneficiary. Number one,
Go for it.
The trust is valid under state law.
Okay.
2, the trust is irrevocable as opposed to being revocable, or will by its terms become irrevocable upon the death of the individual who established the trust.
Gotcha.
Number 3, the trust beneficiaries can be identified from the trust document. It's all spelled out who are the trust beneficiaries. And number 4, a copy of the trust instrument is provided to the IRA trustee or retirement plan administrator. So a federal employee who wants to name a trust as the beneficiary of his or her TSP account, a copy of the trust instrument has to be given to the TSP service office.
Okay.
There's another factor here that you got to be very, very careful about naming a trust as beneficiary of an IRA, or a retirement plan, and that is regarding the RMD. How do you calculate the RMD? I mean, a trust is not a human being. It doesn't have an age. It wasn't born.
Yeah.
It was created on a certain day, but it's not a human being. It's not going to die. If the trust meets, all the 4 criteria I mentioned, and that has to be done by, it has all those 4 criteria have to be met no later than September 30th of the year following the year of the death of the IRA owner or retirement plan participant who set up the trust. Then the trust beneficiaries are considered the beneficiaries for computing the post-death RMDs. In other words, they're going to look at the ages of the trust beneficiaries in terms of computing the RMD. What one has to be very careful about with the trust is the last thing that you want to have happen when it comes to naming a trust as beneficiary of your IRA, traditional IRA or retirement plan account, such as the TSP, is you don't want the money to stay within the trust, because the trust is in itself a tax-paying entity. And trust tax rates are so much higher than individual tax rates. Let me give you an example, Dan. The highest federal marginal tax bracket is 37%. And the 37% marginal tax bracket starts when an individual has approximately $450,000 of taxable income. That's an individual. A trust 37% tax rate starts when the trust has $13,500 of taxable income. That is a big difference.
Ouch.
So what I'm saying is that the trust that is established has to be a so-called see-through, better known as a conduit trust, in which the money goes into the trust to be distributed to the trust beneficiaries. I have to advise everyone listening, please do not attempt to set up this trust on your own. You have to go to a qualified attorney, tax attorney, who will set up this trust so that it meets all the IRS qualifications to be a valid trust. And therefore, as part of the trust document, it'll state that any payments that are going to beneficiaries via are going to meet enough that the trust will be paying out enough to meet any RMD requirements for each beneficiary. Do not try this on your own.
Gotcha. Overarching rule, folks: don't try this at home. You need quality advice on this from a qualified professional. Can't really stress that enough. Once again, Ed, you're the man. You keep all of this straight, but that's some important stuff to pass on to our feds. As I always do, I want to thank you for what you do for the federal community, especially what you do to teach our team. Folks, if your head is not spinning now, head over to the Fed Zone and read Ed's columns. He'll have good examples in there that'll stop the world from spinning a little bit. You'll be able to look at them and go, oh, okay, that's how it works. So that is a wrap. We are serving those to serve. Be sure to subscribe to this podcast on your YouTube channel and Spotify. And remember to share it with friends, strangers, neighbors, you name it. Check us out on Twitter and LinkedIn. Do not forget our live webinars every week. Where you'll be able to listen to Ed and learn from him as part of our ongoing mission. He will reach you where you are, teach you where you are, and serve you where you are. The guru comes to you. Sign up for one, sign up for all. Share that page, especially with your friends. They will thank you for it. It's in the Fed Zone every single week. And even if we don't cover all of those on our podcasts, they are in there for you. Be sure to read them all and share them with your friends. So, wrapping it up for Ed, the crew at Serving Those Who Serve, and me, of course, Dan Sipe, ending as I always do by saying, good luck, Godspeed, and above all, remember, it's your FedLife. Make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.